If we can start off, let's talk a little bit about just to set the scene, the state of the economy in America at the moment. As our sort of resident American on the panel, I think we should leave it to you, Sean, to start us off. How is the American economy doing right now?
Well, times are good. Our president is quick to tweet about. Stocks are at an all-time high, unemployment's at a 50-year low, and interest rates are low, and from a real estate perspective, a very flat curve. So, fundamentals continue to be strong across pretty much most property sectors, other than retail and office to some extent. I think it's a good time to be investing in the U.S. We're focusing our efforts on a core focused strategy, trying to lock in interest rates, own assets long term that have strong sustainable cash flow versus trying to be opportunistic, because a downturn will come. We don't know when and how steep, but today we feel pretty optimistic when we look around the globe. The U.S. is a great place to deploy capital.
Looking forward to 2020, we have an election coming up. Do you expect sort of more stimulus and sort of crowd-pleasing policies to be coming out in election year?
It's tough to tell. I mean, I'm certainly not the expert on that. I do think there will be some volatility for sure in the public markets and probably the debt markets over the next 12 months. I think if from a risk standpoint, if there might be some self-inflicted consumer spending shortages and slowdowns and things that could come up, but I think anything we see coming out of the current administration is going to be focused on continuing to grow the economy, keeping things stable, and ultimately for Trump working toward a re-election.
Christine, let's start with you. Tell us a little bit about where you are investing in the United States.
Okay, we actually invest in like major city for more Chinese people invest. Yeah, like Seattle is one of our top investment area, and also like we also invest in Boston, Texas, in Houston, and then LA, Florida, Those cities is usually is either first tier city or second tier city, and then more Chinese people there, they live in that city,
I mean, places like Seattle are sort of famously, well, possibly slightly overheated. How are you finding the sort of capital gains that you can get at the moment in those sort of places?
In Seattle is last year people think is like overheat, But this year I can see like the supply and the demand is balanced. So the housing price is a little bit slowed down, But we keep positive in this area because I can see that the supply is still not enough. Like the construction cannot support the demand. We still found the shortage of the construction manpower. So our new development is it's hard to find right people in building that sufficient supply to the market.
Is that something that would be slightly off-putting to someone thinking about investing in a new development? Sort of concerns about whether the project is going to get built on time and on budget if there's a shortage of workers? Or is that creating an opportunity in terms of keeping prices up because there's a shortage of supply coming?
Like in Seattle, the demand is slowed down because people is worrying about market corrections. But in terms of the supply, because of the land inventory is still low, and then the construction people is still in shortage. So I think it's still balanced. So we are still positive, and I think that probably next year there will be more supply to the market. So I will not foresee there is a huge raise on the price. So it makes the price is balanced now.
And unlike a lot of other cities in the country too, Seattle has the land entitlement process is very difficult and very complicated, and because of how competitive the market has been, I mean, to buy land, you basically need to buy effectively unentitled land for a very high price, sit on it for 2 or more years in order to get approval to build what you want to build. So that inherently is probably governing more development happening there than otherwise would happen, which I think helps to keep the supply-demand imbalance in check.
In terms of the cities you invest in, which gets you the best yield? You said Boston, Texas, Seattle.
I think Atlanta probably is one of the best city for us. It's the best yield. So we have a project like student accommodation project. It's a multi-family. The yield on cost is almost 12%. Yeah. So it's a last year project. So I think it really depends on your location. So we built it in suburban area. Yeah. So and then the cost is comparatively lower than like in Seattle area, LA. Yeah. So yeah. So I think it all depends on your cost control now. Yes, it's really hard to control the cost, but in Atlanta area, because there is still a lot of supply on construction people for us. So we do a lot of new development because it's for the whole life. We will do whole life cycle from land acquisition, getting the permit, and then we build it, construction and project management until the end of asset management. So we do all in the life cycle. Yeah, and then we found that the yield in this situation is we can like fully utilize our resources to get the best yield. Yeah.
Raphael, tell us a little bit about where you're looking at the moment in the States.
Sure, thank you. So for us, we are asset manager. We focus on our investment in US and Canada. In US, we are a niche player. Rather than going into the traditional sectors like office, retail, and going into the traditional markets like what you have in New York, San Francisco, LA. For us, we look into niche markets, and we are specialized in specific strategies. Geographically, we always want to identify upcoming cities. I would argue Seattle would be one. We are also pretty active in Las Vegas, which we do see a lot of spillover effect from California. On an asset class level, again, we are niche. Rather than going into, again, the large traditional sectors like office, retail, or single-family major development, we are focused in the subsectors, including self-storage, student housing, elderly home, as well as car parks in some areas. That's an area whereby we are spending quite a lot of time. And then also from a strategy perspective, obviously depending on the asset class where we are investing into, but generally we have a very strong focus in our acquisition strategy. We are very much focused in distressed asset. We want to, take opportunity to look into specific opportunities and make a lot of money for our investors.
It's interesting that you say that you're focusing on the sort of up-and-coming areas and more niche markets. I mean, there might be a perception from people in the States, for example, that people in Hong Kong might be a bit more traditional and be going for the sort of prime location, tier one cities. But actually, talking to the panel here, but also talking to other people around Hong Kong, there's certainly a lot of interest in those kind of more emerging areas.
Yeah. The reality is, there's, you've got home ownership, continuing to decrease. You've got, incredible mobility and ability to work remotely on your phone or on an iPad or laptop. So, the reality is you can get a good paying job and live pretty much anywhere in the country. I hired a senior person 3 weeks ago who lives in Charlotte, and I have no interest in him needing to move to Chicago because he can work from there. No big deal. But so cities like like Charlotte, like Nashville, Phoenix, Vegas, they're you can have significantly lower cost of living, much more favorable taxes, and warmer weather, frankly, than going to New York or Chicago or other places that historically have been the place to be. So I think there's a lot of cities that by Hong Kong or Chinese standards are very, very small, are really core markets in the U.S. And it also depends by sector too.
Seems to be a big theme at the moment, the sort of rise of the South again. A lot of these cities down there, Atlanta, Christine mentioned, you mentioned Charlotte. I think Raleigh is another one that people talk about often. Texas.
Austin.
Yeah, Austin, exactly. A real sort of theme as opportunities that might be overlooked in the past, but now are really booming.
And then if you look at some of the alternative sectors, and like you both mentioned student living, cities, we're one of the biggest student housing owners and operators in the U.S., and the towns that we invest in, nobody in this room has heard of unless you went to college in the U.S. Bloomington, Indiana is one of the top markets that we've invested in the country, and there's 85,000 people that live there. It's a 50,000 person university, so by our standards, it's an ultra core market, but it's in a city that's in a state that 90% of this room would never have heard of.
The Cornhuskers, is that right?
Hoosiers.
The Hoosiers. Who are the Cornhuskers?
Point Hoosiers.
Nebraska, that's
point
right, that's right.
See?
There we go. I mean, yeah, your point exactly. Anyway, but yeah, let's talk about student accommodation. Christine, I think you're into student housing as well.
Yeah, so we built two student housing last year, one in Seattle and another one in Atlanta. Yeah, and then student housing is one of the hot topic now, yeah, because stabilized income and people is worrying about the market, but student accommodation is generate a high yield, but relatively stable than multifamily, yeah. So people's like from now they keep aware of the high-end apartment building because, say for example, in Seattle CBD area, there is lots of vacancy on that like high-rise apartment, and yeah, it takes like quite a long time for the developer to lease it out, and then they need to give like few months free rent. Yeah, so the inventory is high now. Yeah, so that's why like the industrial, the money from the industry, they would rather run into a student housing projects. Yeah, and then so now we're more targeting on some suburban area, and as you say, like people usually they run into like phone, and they don't need to work physically in CBD area. So some of the apartment we'll build in maybe in some suburban area, yeah, just right next to the school, and then part of that is rent to the student, and another part of that probably you can rent it for the other neighborhood, yeah.
What sort of yields are you expecting on these accommodations?
We do a lot of new development. Yeah, we do a lot of partnership with the local builders, and yeah, usually it will take around like 8%, 8 to 10. Yeah, so and then we run into this business for after several years. After it stabilized, and then we will hold it for like 5 to 6 years. Yeah, and then exit it. Yeah. So this is our strategy. So we run a few multifamily as well. Yeah. So relatively lower yield than this. Yeah. But so that's why I think student housing is when you do your design. Yeah. So if this is good, yeah, like every room is furnished with the student living in like a co-living space. Yeah, you have a place for them, like a common areas, and yeah, all this utility. So people, they love to come to stay in your apartment building. So and then the years that you built last year there is 120 rooms, but originally we planned for only 80 rooms. So it's enhanced the yield, yeah, because for more rooms to lease it out, yeah. So it really depends on your design. So because we run a lot of groundwork, so we build it from the ground. So we will enhance our designs in order to improve the rental yields. Yeah. So this is our strategy. Yeah.
Fantastic. Steve, how does that compare with some of your projects?
Yeah, I think it's similar. We're generally, depending on the market, anywhere from a 5 3/4 to 6 1/4 return on cost, which probably gets you a 8 to 10% cash yield at stabilization. Urban markets like Seattle or USC, UCLA, they're going to be tighter than that. Berkeley, and then if you go farther away from campus or to secondary schools, then it's going to be a little higher than that range. But it's the same thing we're seeing. But similarly, we're focused on continuing to redesign how we build and operate student housing. Figure out ways to bring prices down. The sector has seen supply, so there is some price sensitivity there. But ultimately, we're doing that across our multifamily, senior housing. Really, everything we do is shifting to more of an affordability approach, because the majority of what's been built over the past 5 years has been the very top end of the market. That while there's still some opportunity, it's a little saturated, and I think trying to build a little more affordable price point. So new properties in great locations that are at an approachable rent level is something we're very focused on.
What sort of things have you done to achieve those cost improvements?
I think more efficient unit layouts, shrinking the size of unit, not just making them smaller, but making them more efficient. So you keep all the same functionalities and features, but just maybe a little bit smaller. having more common areas and more social areas for people to spend their time in versus sitting in their apartment. And just looking at finishes and fixtures and things like that, and trying to find some opportunities there. There's some construction technologies out there, and people that are exploring new ways to further cut down supply chain timelines and things like that. But not a lot of that's not quite yet proven. But that kind of stuff we're constantly looking at.
3D printing buildings and things like that. Absolutely.
Coming.
So Raphael, tell us about some of the niche areas, niche sectors you're looking at.
Sure. We like distress, and distress is a very general concept for a lot of people. But for us, I think we are looking into a lot of opportunities, capitalizing on the differences and the gaps in the legal aspects of ownership and titles, and to take advantage in these entitlements and make money for our clients. So effectively, we are very much focused and active in the foreclosure side of the real estate businesses. Foreclosure obviously is an easy concept to understand, but practically is extremely difficult and challenging to go through all the work. For us, in this regard, in fact, we have a fairly big team with lawyers, with title accountants, all these professionals to help us to focus on, getting through all these assets in the foreclosure space. This is a fairly niche segment of businesses, of course, within real estate, much smaller than what we have in the development space, in the income space, but for us, we look for good returns for our investors. We look for phenomenal IRRs for our investors. So this is an area whereby we have been focusing a lot. On the subsector, I think like what we have all mentioned, I think we've all agreed the potential and the prospects for, say, student housing, for elderly homes, etc. And for us, again, we are diving right now very much also into the self-storage businesses. Self-storage businesses, again, for us, we come from a capital market world. We have our capital market team. And for us, we understand, and I think in particular, the type and the profile of assets which are sought for from the capital investors. And predominantly for us, we look into the multiples of a lot of these subsectors in the listed space, and we will try to see the opportunities, the challenges, and also the deals which we can get to facilitate that trade. So self-storage, again, is something which we like to look into. In fact, if anything, the business is simple and complex. Simple in a way for people to understand the merits of this subsector. Is very inelastic to economic cycle. It trades at a very, very high multiple against other REITs, other traditional subsectors like office or retail. But then at the same time, we also appreciate the complexity of the operational side of the businesses, which we are pretty comfortable about. And I think this is also one of the sectors whereby it will continue to grow pretty rapidly in the US.
Why does it trade at such a high multiple?
Just looking into the inelasticity of the businesses against economic cycle. A lot of people, of course, will use the 2008 financial crisis in US as a benchmark, and to look into how secure these assets perform under such a stress environment. And people also look at the multiples, look at the operational statistics, and as you can see, for a lot of what we call the grade A assets in the traditional sectors, like in office, even a grade A office, occupancy can go down like 10-15%. Under those kinds of stress period, say what we had in 2008. Retail, which is supposed to be much stronger because people still need to go and buy the groceries and all those sorts of stuffs. The occupancy goes down, say 5 to 10%, much better than office, but it's still not good enough. But if you look into the subsectors, like all these subsectors which we talked about, student housing, elderly home, airport car parks, self-storage. If you look at just the operational statistics, if you look at the occupancy, how they perform during these stress environments, they went down maybe like 1%. and whereby, again, the capital market will tell you that as well on the higher multiples. So I guess for us, when we look into these, niche opportunities, this is an area whereby we do believe that we can, bring our value add to our clients. I think for a lot of our clients, they do already have a lot of exposure in the traditional markets, in the traditional sectors, and they are exposed. And if anything, they have all the good connection and all the good sources. They are exposed anyway. But I think in particular in Asia, we do see a lot of interest into these secondary markets, new sectors, and whereby I think the opportunity and also the knowledge base will continue to be well sought after.
I think you nailed it on the head. I mean, a lot of those are all they're basically the buzzwords of the real estate sector right now because people haven't been active in them for a long time. But the recurring underlying theme is that they're necessity-based real estate sector. So if you go to school, you need to live somewhere. If you live in a city, you need to live somewhere. If you self-storage is not correlated with the economy because it's event-driven. It's driven by people moving, by divorces, by usually unfortunate life events. Senior housing is driven by need-based. We don't like the age-restricted housing and independent living where you're choosing to go live somewhere, but when assisted living and memory care where you're basically required to go live somewhere because you need help with activities of daily living, then those things are all driven by necessity versus just deciding to spend like retail.
Absolutely. Do we have any questions from the audience? Anyone want to know our panelists' thoughts on any particular city or sector? No? Well, if you do, then just stick your hand up and we'll get a microphone to you. Let's talk about some of the challenges, hurdles facing people investing into the States. For a Hong Kong citizen, a Hong Kong resident, what are the challenges of ownership, owning something in the States or investing in something in the States?
So I think the challenging now is people is worrying about the market, whether you will correct. Yeah. So for ourselves, we do more short term now. Like we do a lot of single family house, townhouse, master planning community. Yeah, we just build and sell it. So because we hold a lot of portfolio in the past. So for the capital that we raise now, so we expect a short duration, maybe 3 to 5 years. So and then of course there is an opportunity is that the market slow down, so it's easiest for us to get permit ready land. Yeah, so that we can easily build just right after the acquisition. So so put things together, then we can just build it. Yeah, and then I think for capital raising is tough now for Asian money, but Asian still capital is still rich, but it really depends on where do you raise it, like from China? Yeah, it's really tough. Yeah, so so it's you need to be diversified your capital raising. If you go to China, you have to like Asian money, maybe Korea, Japan, Southeast Asia. Yeah, but opportunities is still there. Yeah, and then also I want to mention about opportunity zone. Yeah. So we also want to set up some fund is for longer term, like 10 years, for that money because of after the tax reform, there is some area that is they allocate it into a zoning is a special zoning, so you can pay tax like after 10, 15 years, so it's a free. So I think this is some of the opportunity that if your money is can tolerance for the long term. Yeah. So probably next year we will run into a fund like this for long term capital. Yeah. So we will some area like. Not in rural area, but some like suburban. Right? So people they would love to invest in that area. Like say for example, we spot a opportunity in Portland, Oregon. Yeah, and we can build it for multifamily or senior housing or student. Yeah, because there's the zoning you can change. Yeah. Yeah, so that's the area. So it really depends. So, but I think it's if your money is a long-term money, you can think about this kind of opportunity.
And there's tax benefits for that, yeah?
Yes.
What sort of, what tax benefits? I mean, what are the numbers?
So like, yeah, you save a lot on your capital gain. Yeah, so now, I don't know if you know about like, now there's for capital gain, short-term capital gain, within a year you pay high tax. So we usually pay long-term capital gain, like for our short duration, like multifamily homes, we sell in 3 to 5 years, then we pay long-term capital gain. But for opportunity zone, there's no capital gain if you can hold it for like 10 years. Yeah, and then also there is a lot of tax. You can negotiate with the city. Say for example, we have one building that we get tax-free for 10 years. Yeah, but it's a student housing. So this is one of the first student housing, just right next to the new branch of Washington State University. So they give us a free tax the property tax for 10 years. Yeah, and then we sign a master lease with the school. Yeah, so and then the school guaranteeing us for every year there is 3% increase. Yeah, so I think it's a good deal. Yeah, so. So that's why I think opportunities is still there, but you have to be more tolerant. Yeah, the tolerance level is higher. You cannot say, hey, I want some quick money, quick return. Yeah.
Steve, any recommendations for people investing, things they need to look out for? I mean, Christine's mentioned taxes there and some fantastic tax avoiding opportunities.
Yeah, I mean, the reality is, this cap rates are low. I mean, it's, the big difference right now versus the last, cycle end is that, lenders are really holding everybody in check. So you can't go out and get 85% non-recourse construction loans. So I think there's kind of a natural limiter on how aggressive people. I think a lot more people would be a lot more aggressive in the U.S. if you get 85% debt. If you want to get higher than 60%, it gets very expensive. So I think that definitely helps. I think you just have to, whether it's looking at the market or sub-market, just looking at the underlying supply-demand fundamentals and the supply that's coming. I mean, that's the key. I mean, it's all about being able to hold your rates and maintain cash flow at this point of the cycle, in my opinion. Preserve capital and hopefully make a good return versus trying to hit a home run and the fences move on you and you're stuck.
And Raphael, any advice for people going to America?
In fact, I think we have covered a lot. I think what I want to again highlight would be the tax issue, whereby predominantly is still a pretty big concern or pretty big unknown to Asian investors. And again, coming up from a financial capital market background, we all understand, the complexity and the challenges. For an investor in Asia to go through the kind of that they need to understand what they're exposed. I think to a lot of Asian investors, it's more like, okay, I'm going to buy, I'm going to invest, I'm going to sign, and I'm going to off. I will see my return in 3, 5, 7 years. Perhaps that is the case in Hong Kong, or if you buy a stock fund. But when you are investing in direct real estate, be it in office, real development, etc., ultimately is a very complicated and complex subject for them to understand. And I think that's where all of us on the panel can bring in the value add to facilitate these types of investment. If you like U.S. investment, you probably need to go through us because it's impossible. For anyone who want to do it by themselves.
So find a good partner.
Yeah, I was just selfishly going to say that. Finding a good operating partner on the ground who knows the markets, has in-house operations, really can navigate through good times and bad is key. Because especially if you're investing there from Hong Kong or China or elsewhere, that's halfway around the world. So the ability to react to something is going to be slow, and really understand what's happening on the ground is difficult if you're not actually there seeing it happen.
Yeah.
Fantastic. Well, we've just reached the finish there on the clock. So if you have any questions for our panelists, please do go and see them. One of the key messages there from the panel was to find a good partner who knows the market well to help you through that. So please do speak to Basel Capital, Mount Logan Capital, and CA Ventures if you want to know more about investing in the States. But that brings us to an end there. We have one more meeting going on next door, so there is an opportunity to go and grab the chaps next time. So can I have a big round of applause to our panelists? Thanks.